Welcome back to View from the Ranch. My name is Greg Pacitti, and I'm here with my Chief Investment Officer, partner, and
friend,
weatherman. I don't know. What's this outfit for this month here, Brad?
Well, Greg, you want to talk about back to school, but I'm from Pittsburgh, Pennsylvania, small town, Western PA.
Mm-hmm.
And up north, we never went back to school till after Labor Day. So It's kind of like next month. But, if you live here in Florida, especially here in Sarasota, the last week or so, we've gotten about 10 inches of rain. Seems like it rains every single day, every morning, every afternoon.
Getting into the hurricane season.
And that's the real thing. We got to be prepared. We got to be prepared for these hurricanes. Yeah. Thankfully, due to my skill in meteorology, I think the oversized El Nino that's down in the Caribbean or the Pacific or the Antarctic Ocean, I don't know.
One of those oceans, yeah.
Yeah. A knock on wood. I think we're going to be okay this year, but it's getting to be that stress time of year for us. So I'm just getting prepared in case.
Prepared, yeah. You wear that every day now?
Only on days that we're doing videos.
Okay. Gotcha. Or
days that there's actual hurricane warnings.
Yeah. Well, that makes sense.
Yeah. It's a little small. It's a little hot, but
Could it be like a foreshadow of maybe some financial storms that may be brewing as well?
Oh, Greg, I love your tie-ins, but
I gotta tie it in.
We're getting that part of the cycle for the midterm election year. Yeah. So it's August and September. Like we say, don't sell in May. It's sell in August and come back in October. So
if you're a trader, right?
Correct.
Yeah. Most of us aren't going to do that, but it is a nice thing to kind of get prepared. Like, it's normal to have pullbacks August, September. Historically, I read this, so you'd be proud of me. Since 1928, August through October has usually been, of course, the worst 3-month period, averaging a negative 0.2% return over those 3 months and an average drawdown of minus 7.5%. So historically, we're coming into a tough season. Some storms may be brewing. So I think you're dressed appropriately.
Well, I can probably imagine you used a lot of spreadsheets to come up with that data.
I did, yes. Claude. ChatGPT, one of the two. We will fact check, but that sounds accurate, doesn't it?
Opposite view, August used to be the best performing months up until 1950. Usually the first half of last century, it was the best performing month, and that had a month out of all of them that had a lot to do with when harvesting was, because so much of our economy back then was based on agriculture. But since the 50s, not so much.
Yeah, got it. All right. Well, let's talk about July. July, the market eked out. Like S&P was just at the last day, eked out a positive gain. The Dow was up slightly, and the NASDAQ was down 2-3%, depending on the NASDAQ index, or some of the more concentrated, like NASDAQ 100 was down worse. Some of the big mega caps took a kind of a beating. There was a lot of selling going on in July, especially on the retail side. I did read this, that the average cash balances of retail investors had increased, so that instead of buying the dips, they were more inclined to sell. And so, and then leverage ETFs also, the participation in those also decreased, and so it seemed like people were de-risking in the month of July, heading into August. So what was your take on July?
Looking back now and seeing that we basically ended flat in the S&P, and to see that we had maybe one of the worst Julys for the 10-year yield on the 10-year Treasury, rising so much. We saw a pretty significant spike in oil with the increase of conflict in the Middle East.
Without that, do you think things would have been different?
I'm not sure, because we were dealing with South Korea that had all the markets are pretty much interconnected. So the South Korean Kospi, which is basically 50% two stocks, Samsung and Hynix, SK Hynix, two big semiconductors. I mean, at one point last month, the index was down 35%. I mean, it was a significant crash.
Not that many people probably even know about that.
Yeah. On top of that, we had, last few days of the month, we had a $45 billion, hedge fund here in the US that was highly leveraged to uh, AI investments, kind of blew up. So considering what was thrown at the market, it's pretty impressive that things were able to finish flat. And, the NASDAQ, Russell, they were down slightly. But again, for the amount of selling that had been taking place during the month and the pattern that was happening each day, the market opening higher, making a high around 10:15, and then selling off the rest of the day. Those patterns aren't very constructive, but again, the end of the month, we were able to pull things out, and seems like we've got the market to settle down here a little bit,
Mhm.
hopefully.
Yeah. I never like seeing these like one-off things that start occurring more than once, I guess. And it seems like those are typically the cracks start appearing. And
Well, we talked about like some of these in country-based index funds, like the South Korean index fund.
mhm,
I mean, it was up 300%
yeah,
from the middle of last year. And we've had these funds around for probably close to 2 decades now. They never really move. And now you got these explosive moves. So
yeah,
the Korean market is interesting because there was a massive amount of leverage that was in place. And that leverage caused a massive amount of margin calls and forced selling during the month of July. Roughly, I think it was like 1 out of every 4 accounts in the country had to be sold out because of the leverage and the margin that was there. So excessively greedy. The price still has some more to go, but at least for now, it seems like it's calmed down.
okay. And how about breadth? You always talk about breadth, which measures
Yeah.
the participation of stocks. I mean, it seemed like a lot of the big tech names that were driving the market, those didn't have a great month, but other areas is what really helped keep the markets up and keep
We hit
things
we hit a new
pretty
high in
good.
the NYSE during the month, breath. We hit a new high in the S&P at the end of the month. The one thing that's interesting is the equal weighted S&P 500 index made a new all-time high versus the market weighted or cap weighted index. So showing that the other names outside of tech have been doing the heavier lifting, which is always a positive. We want to see things broaden out. Now, if you're an index holder or people that are highly invested in tech, it's not going to look so well because you're not participating. Okay, that's like 1 out of every 12 months you're not participating.
Right.
But if we can keep that expansion going, that's very much a positive. Again, I don't think it lasts. We saw this earlier this year in July and February. I don't think it's going to last. At the same time, the breadth for the bond market, whether it's a total market or high yield, was absolutely horrible. The total bond market breadth, it's hard to equate because more issues are traded now than, say, 20 years ago or 25 years ago, but just a lot of selling. And you don't really want to see that. That kind of points to a liquidity issue, which hasn't shown up in other areas, but we like those numbers to be a little bit smaller, close to even, not so much daily selling in bonds.
Yeah.
Um,
It's tough for the entire market when interest rates are going higher. I guess the 10-year yield rose like 7%.
and it plays off, they all play off each other. So,
Hmm.
the CPI data and other data points actually has been pretty good, but when oil spikes, it's pairs trade. Here we go. Oil up. Here goes yields.
Hmm.
Here goes expectations of higher Fed rates. So
Yeah.
it's all self-feeding, which the pain of energy prices and oil on CPI is relatively short term. The benefit to inflation right now is that the housing component, the shelter component, is coming down relatively quickly. It's finally starting to show up. And even here in Sarasota, there's a big article last week about how rent prices are starting to collapse. So we're finally seeing the largest component of CPI move lower.
Hmm.
The increase in increase in oil and gas, that may offset some of it, but it's not going to cause inflation to really blow out.
So oil went from like $72 back up to $99, and that just kind of set off a domino effect. Interest rates spiked. I read that the 30-year Treasury was at the highest rate since like 2007,
Hmm.
and so cost of everything is going up, and that's just sending waves. It just a matter, is it sustainable? Is it going to stay there? Are rates going to continue to go higher? What's your thoughts on rates going forward?
It's hard to say.
Yeah,
You can't really be perfect anymore in calling them.
you're not perfect.
Only with my costumes.
Yes, that's
Um,
true.
I do think that once we get past this year, things will settle out a little bit more just because of all the refinancing we have to do in the Treasury this year.
Mhm.
Um, my longer term view on oil is is much lower in price with UAE, Venezuela, us being able to add much more supply to the market, forcing, OPEC to increase production to maintain.
Those are kind of longer term
That's
things.
longer
Yeah.
term. Short term,
Seems like it just depends on what's going on over in Iran, right? I mean, the last minute we canceled our, I don't want to say invasion, but whatever strike we're going to go
yeah,
against
this is going to
Iran.
keep going
Yeah,
on and
it's like
on and
not.
on. I
Yeah,
think you can have your good days, you're going to have your bad days. We really need to find an off ramp out of there, but um, it would be helpful if we got other countries involved if this is going to escalate. If not, we need to find a way out.
hmm
And it's just a tough situation right now, I think, to be in.
yeah. You think they'd have some incentive with the mid-year elections?
Yeah, which is, I don't want to go down the political side of things, but this conflict is not helping out at all, whether it's from a no new war standpoint or from a cost and inflation standpoint.
Yeah,
So, um,
it's affecting gas prices. I mean,
mhm.
they're saying high, and we always talk about this K-shaped economy where, the haves are doing well, the have-nots are kind of tapped out, and high gas prices certainly aren't helping. And
Well, I think we see gas start to, it should start to lose some of its demand simply because the summer's over with. People, kids are going back to school, so people aren't going to travel as much. I look at the commitment of traders data, the big money traders, and where they're positioning, and I can say that over the last 2 weeks, the cot traders have gotten much more short oil.
Mm.
Basically, they're saying that they're trying to hedge any long positions that they have. So they're normally short oil all the time, but the amount that they're short now is one of the largest short positions that we've seen so far this year, and it's much lower than where it was a couple weeks ago. So big money traders eventually see the prices coming in. Now, as we know, some tweet from somebody can send it flying up $10 a barrel, in 5 minutes. Whether it's true or not, it will come back to where it needs to be. So we just need to get through this volatility, get this conflict done. Then I think long term that the price eventually settles lower and then continues to go lower. Um, Back to some pretty nice numbers for a lot of people too.
Okay.
And that would be wonderful for the entire economy. I mean, if we can get oil down to where it should be without control of OPEC, a lot of the problems that we have today are going to be a distant memory.
All right. That'd be nice. So the top two performing sectors last month was of course energy, right? Because oil spiked up like 12%, but also financial services were up over a little over 6%. So is are the banks making money because the interest rates are higher? What's your take on why the financial services
Oh,
sector
I
is?
think they're kind of in a sweet spot
Mhm.
because their businesses are running very efficiently. They're doing very well on their spreads. They're not having to worry about this massive default risk that has been coming over the past couple years, especially in the commercial side. Really seems to kind of have died down a little bit. So the amount of negative loans, charged off loans, provisions set aside has greatly come down from where it was last year. So the banks are much more efficient. A lot of them are using AI now. They're much more efficient. The bigger banks are the money center banks have done extremely well this quarter. Um, some massive profits. But we've also seen regional strengthen too, which is important because the overhang to regionals the last couple of years is most of them are involved in commercial real estate. So finally, that pressure is kind of getting off of, as an overhang on their stock prices. So
Does the, before a couple years ago, 2 3 years, when interest rates started spiking and a lot of banks who own treasuries were underwater, and that was a big story. How is that different, I guess, now, versus a few years back if interest rates are up? Because really, if you own any bonds right now, like in a diversified portfolio, your bonds have been a negative drag this year. Like they have not contributed
yeah,
anything. Long-term bonds are down like 5% for the year. 10 and shorter 5-year bonds, maybe down 2 3%. So a balanced investor who's doing the right thing, not having everything in all stocks, but having some bonds in their portfolio, certainly going to be underperforming the stock market as a whole because the bonds have not contributed anything. And so I do wonder, like, if the banks are holding a bunch of treasuries, I mean, they've got to be underwater. That story doesn't seem to be popping up anymore.
treasury yields have been flat now for 4 years. Um, the problems that we had in 23, which I mean, they were kind of bailed out with the facilities that the Fed and the Treasury put in place in, was it late March, April of 23 to help with liquidity.
I guess interest rates went from 2%
That,
to
well, what I'm
6.
saying
That's
is
a big
you
move,
just
yeah.
talked about the 30-year hitting a new, a multi-decade high. You go back to some of the problems that these companies had with their held to maturities treasury positions. They had 30 years that were paying barely 1%.
Okay.
Now we're sitting with 30 years well above 5%. So we've been in that position now for a while.
So they've worked it
The
through
initial
already.
shock that we
Yeah.
had, it's kind of like what's going on in Japan now, because Japan has been negative to, you know, no to negative interest rates for 20 plus years. And the last 2 years or so, they've started to raise rates ever so slowly, but they've been so used to that environment that move off these lows is causing, cause some dislocations at times. So the problems, I don't foresee the balance sheet problems getting worse unless, bond yields go crazy again, which I don't see happening.
Yeah.
Because when you look at the treasury statements each month, some months are good, some months are bad. The problem is our outliers are so massive. Whether it's Social Security, Medicare, Medicaid, all these other additional benefits, they don't go down now. So we've got to find a way to have to keep feeding that monthly expenditure. If it gets to be too much, then there's going to be pressure on yields.
And the housing market is pretty steady. I mean, it's seems to have flattened out. Your people aren't like back in the day using their house like an ATM
Yeah.
machine. So there's not a lot of. So I think the banks seem to be in a, like you said, in a sweet spot. Do you think that trend continues for the banks?
I think the trend
have some money there.
Yeah, and we own a lot of banks. They've done very well. Problem with any of these companies that have done well is I think we're going to eventually get into periods where it's much more harder on comparisons from a year over year basis, where a company this past quarter may have, increased revenue by 20%. This quarter next year may have increased revenue by 12%, just because they're so strong. You just can't keep, other than some of these companies like Microsoft and Amazon with their cloud businesses that can just keep growing and compounding growth every single quarter, it seems. You'll start getting in some tough comparisons that will probably have some gravity-inducing moves to the company stocks.
Gravity-inducing moves.
Yeah,
moves.
not
I like
saying
it,
they're going
yeah.
to take off. They're just going to
Yeah.
not rise as fast.
Gotcha.
The one thing that, again, this is all connected. So you talk about housing and talk about mortgage rates being higher now because of where yields are. Again, that's a positive for inflation because it's going to slow down the amount of housing activity and force prices to eventually have to come in, which again helps the CPI, the shelter component within CPI.
So, and the Fed recently met. What was your take on
I
the?
love it. I love
Yeah,
Warsh.
yeah. I've
He
never heard you
just,
say anything positive about a Fed chairman.
well,
So,
I wait till he does something I don't like, and then I'll
yeah.
probably throw him under the bus. But his statements are very short. He doesn't really mix words during his press conferences so far, and talks more about realistic instead of saying what can happen or what may happen or what might occur. Maybe this will happen. It's just data driven.
Short and
It
sweet.
will take some of the guesswork out of it.
And they quit doing forecasts. Is that right? Like they.
Yeah, because there's really no reason for them to sit there and give you an expectation on the number of rate cuts or rate hikes we're going to have, because as we've seen the last 5 years, they're always wrong. I
Mhm.
mean, in 2021, we should have been raising rates, uh, you know, relatively quickly, yet we kept them at zero, and we're throwing $120 billion of stimulus into the economy each month. And then we saw what we had to do in 2022. So it's really just looking at the data. The data is going to tell you. That might cause them to move rates around at some point in time more often than what we've been used to the last, say, 2 decades. But
You think that's probably the right thing because you have like right now the 2 year Treasury is at four and a quarter, somewhere around there, and they kept rates at 3.75, and so does that tell you that maybe he might?
well, based on our belief, as we had the other way when that we thought the Fed was being too tight and the 2 year was lower. I mean, the 2 years showing you that they probably need to raise rates. And it looks like what they'll do in September at their next meeting is a 25 basis point increase, which is more than already priced into the market.
Mhm.
But to keep things in line from that aspect would remove a lot of this boom and bust that we have. Will remove a lot of this period of overstimulation that then stops on a dime, and the entire economy has to then,
Reset.
I wouldn't say reset, but has to get back in order relative to where rates are. So, I mean, look at 2022 as a perfect example. Things were going very well in 21. Numbers were looking good, bouncing back strong from COVID. And then it saw that January 5th FOMC minutes gave some inclination that they were going to have to start raising rates quicker and remove stimulus, and things went straight downhill. The market had to adjust.
So you think it's a good thing? I agree. Yeah, not to forecast what they're gonna do, and everybody just shifts that day pretty quickly. And
Hmm.
when it doesn't meet expectations, it's always a violent thing to switch. Risk on, risk off.
Well, we got in this
So
pattern really during the financial crisis of excessive transparency with Bernanke as well as Paulson at the Treasury, which was much needed then because of nobody knew what problems were going on. But that stayed in place through uh, yelling at the Treasury, Jay Powell at the Fed. It's like, we'll give you more information, more information. We don't need, the public doesn't need this information.
mhm.
Just let them do their job. They don't have to tell us what they're doing every day. And when it comes time for their meetings, give us the decision and the rationale why it was done.
Okay. Now earnings have been occurring. Some phenomenal earnings. I
Hmm.
mean, profit margins are at all-time highs. I mean, is AI solely the reason for all this? What's your thoughts on?
I think there's more efficiencies out there.
Mhm.
I think a lot of these companies have been able to adjust to where interest rates are, where the Fed's at, benefit from AI, benefit from new opportunities either domestically or foreign, um, as well as there's some benefits now from refunds from tariffs that have helped out. Um, they go basically to the bottom line with earnings per share. But that's money that's also back inside the company that can be used either for, shareholder benefits, buybacks, dividends, finance new projects, and hire new people.
Mhm.
But in total, the numbers have been fabulous. And most of the companies, I think, 86% of the S&P has reported so far has beat on earnings per share, plus 70%, I think, is beat on sales. And they're going up against some tough comps, too. It's not like 2025 was a bad year economically. So,
Mhm.
I mean, the one area that does stick out are the large tech companies that continue to spend. So it's both positive and negative, where we'll see a company like Meta slash Facebook that keeps spending and spending and spending, but isn't showing much for it yet. Their free cash flow went from 8 billion a year ago in Q2 down to like 700 million.
Wow.
As they've keep, you know,
Going
they're
all
probably
in on
upwards
this.
of
Yeah.
close to 200 billion for the year on capital spending. But on the same side, you got a company like Microsoft, which was their earnings last week were huge for the overall all market due to all this spending. They're not spending nearly as much, but they're still spending a ton of money. Yet, their free cash flow only declined from like what 23 billion the same quarter last year to 19 billion. Um, their investments in AI are really starting to show
Okay.
and starting to drive revenue. Same thing with Amazon. Amazon's operating income was excessively strong, even with all their spending. So you're starting to see some of the stuff start to pay off. And the companies that can monetize AI that way are just going to keep going.
Mm.
Um, and other companies will have to play catch up.
Yeah.
So,
And a lot of companies are benefiting from that spending and
yeah.
riding the coattails of that. So the
Well,
matter like, can they continue to spend, or does that start teetering off a little bit later this year?
I was thinking the other day whether we had a recession. I mean, technically, we had a recession in 2022. From a technical standpoint, we had a recession. Um, they tried to say it wasn't one because of the employment component. I don't really care about the employment component. It's more about GDP. After that, well, we were supposed to have a recession in 23. Oh, wait, no, now it's going to be 24. Now it's going to be 25. I mean, this AI spending, basically saved us out of any recession at that time. Um, and now it's expanding even further. I mean, the spending is starting to move into a number of other industries. So it's having kind of a trickle down effect. And I looking at what a lot of these companies have said so far, expect capital expenditures to be up again in 27. And then maybe they might plateau in 28, but
Okay.
I don't know. Because if Microsoft and Amazon keep reporting the way they reported, a lot of these companies are going to have to keep spending at much higher levels to catch up. And that's not really positive. But in general, earnings have been great. Outlooks have been really good. Um, sure, there's some misses on earnings, but company has good revenues, or misses on revenues with solid earnings. There really haven't been any blowups yet, which
Okay.
is good.
All right. And let's talk about the jobs. Like, let's talk about some of like GDP came in a little light, 1.5 versus 2.1. The unemployment number ticked up, 4.2 from 4.1% unemployed. So it's not like cracking, but it's kind of trending the wrong way. Is
None
that
of it
something that
makes
we're
none of it
yeah?
makes much sense. There has to be a new way to do all of this to figure out these numbers. I will say that we've seen lower weekly jobless claims the past couple of weeks. I mean, even 2 weeks ago, I think it was one of the lowest numbers we've seen in a couple of years. And then
Although you hear like people are not
and that
getting,
may be the case. I mean, there
getting,
might not be people participating, but that's been a factor in these numbers for a long time
yeah,
now. So
like
if
people
long,
not trying to get back into the job
yeah,
market, like they're just retiring, or they're, because of the age, population.
I mean,
Uh,
weekly claims have remained, on the much on the lower end, as well as continuous claims remain on the lower end. I think until we see a significant move of weekly claims above 300,000 that sustains itself for a while, I don't think there's too many problems out there. Main issue is we deleveraged from government jobs over the past year and a half, 2 years, whether people like it or not. Again, there was a massive overcapacity, overstuffing of government jobs in 23 and 24, well past anything that was lost during COVID. And now that's all been purged back out, which is necessary because we need a smaller government based on how our economy is right now with all the spending that's taken place. And those jobs are net negative as far as taxes go. So, and the mix still isn't great. We'd like to see more manufacturing, other, blue collar type jobs, but there's no problems yet.
Yeah.
I'm not saying everything's perfect, but there's no problems yet. And until we see weekly jobless claims stay above 300,000 for a couple of weeks, I don't think there's anything really to be concerned about as far as jobs go.
Okay. So kind of a Goldilocks type of economy, would you say? Like not too hot, not too cold. A lot of spending still going on. Profit margins are at record highs. Is that sustainable? That's to be determined. And but
Again, to get through July and have just about every area of the market, doing pretty well this year, um, in a midterm year, and with everything else that's going on, whether it's the way bond yields have run up this year, the way that oil's run up this year, there's a lot of positives out there that if people just get away from the negatives, they'll see there's a lot of good things that are going on.
yeah, I
And
mean, without that, it could have been definitely a lot worse. All these news headlines, like if the economy and the businesses weren't doing as well, like they've absorbed that the couple shocks, like not even huge headlines, and
and even the secondary numbers, whether we look at PPI, manufacturing PPI, ISM numbers, um, retail sales, personal spending, personal income, they're all relatively good. And they're not great, but they're not end of the world. And we run into political season here where you're gonna hear how bad the economy is. Um, it's the same stuff people were saying 2 years ago before the presidential election, which the economy wasn't that bad at that point in time. Wasn't that good, wasn't that bad. And we're here now where I think the economy, not too hot, not too cold. I think it's a little better underneath the surface. The main question now is if we can just get oil down, and to bring oil down would be a much, much, much um, stronger economy going forward.
yeah. And the PE ratio for the market's been hanging around 20.
Mhm.
Um, Not like the earnings part or the multiple is not really going up. It's the earnings. The earnings are going up and along with prices. And so it hasn't really been, you know, inflated. And I think I did read that the tech PE is now back down to like 20 from where it was like at
Yeah.
2024 or something like that because they had a little reset, but earnings have been going up double digits pretty high. And so, I mean, they're not overly expensive. It doesn't really look bubblish.
Well, there's been a lot of volatility in tech this year. I mean,
Hmm.
there's some areas that have gone crazy, like the memory area, but you look at the major companies out there, whether it's Microsoft, Amazon, um,
Nvidia.
Google, Nvidia, Apple, Broadcom, um, especially the bigger companies that are spending so much and issuing some debt. The street treats them like the debt that they're issuing is lower than junk grade, which obviously is not possible. But the way that they have punished some of these companies because of it is it's kind of humorous because their balance sheets are still incredible. Any company out there would take these balance sheets. Sure, their free cash flow has been compressed over the past few quarters, and in some cases, some of the companies really have to start showing that they're monetizing all the spending. But it's humorous the way that the opinion on the street changes on companies just for certain reasons, whether it's excessive spending. Um, It'll lead to opportunity. Again, there's some things that are overvalued. I mean, there's a lot of tech stocks that still look excessively overvalued. Um, Whether they come in or not, or they stay that strong because of spending, who knows? It's just, again, to sit here in August or the end of July in a midterm year and have the market up versus say where we were in 2022. Um, I'll take it all day long.
Okay. All right. So we're heading into August. What's your which last month we actually thought the market would be higher because of the historical data. I mean it break even, so I wouldn't call
July,
it a
again,
win.
July's always been the best month.
Yeah, but we just had a couple without the the war acting up again. That I think that
So August being one of the worst months, maybe it's the best month. Um, it's all predicated on what bond yields do. There's no Fed meeting this month. So we don't have to worry about that. It's predicated on what bond yields do. It's predicated on where oil goes based on what the conflict is in the Middle East.
Okay.
Most of our big market moving earnings are behind us. There's still Nvidia in a week or so, but the bigger names are behind us.
We got a big jobs report coming out.
I don't, jobs is jobs. The problem is if jobs is too good, it's going to put pressure on the Fed to raise rates. Jobs are bad. That's great because it takes pressure off the Fed to raise rates.
Okay.
So you
Good
can't
is
win.
bad is
Yeah,
good.
you can't win really either way with them right now. And I just think that August and September are going to just be digestive months. Whether they're up or down, I just think with a lot of the issues that have been going on the last month and a half, the market needs to digest
Yeah.
things that are going on.
And if there's a pullback, like I mean, it's normal and they happen regularly, so don't panic. It's not like everything's over. I would say use it as an opportunity to dollar cost average a little bit more. We talked about that last month, and get ready for the fourth quarter, which we still expect to be strong, based on what we talked about in the earlier months of having 16 positive years in a row with such a great start. And it seems to me with everything, unless something comes in from left field, the spending is still there and the earnings are great, and it doesn't seem like anything's kind of in the way of that.
the main thing is to get through August and September gets us to the sweet spot.
Yeah.
And for some reason, the calendar for midterm years always bottoms right around the end of September, beginning of October. And then that really kicks off the pre-election cycle, even though it's a month ahead of the midterm elections. That's the sweet spot of the market over the next year from basically beginning of October through November of next year. Don't know why. It's always the point where the market does the best.
All right.
Maybe it won't this time. 2018, we had some pretty tough days that last quarter, especially in December of 18, but then things turned around and flew for most of 2019. So just got to get through these 2 months, get to the good part of the calendar, and then have a lot more conviction about things improving as a whole for the entire market.
All right.
Not saying the market's is horrible. We just want to get everything flowing together, which means, we want to get the bond market moving the right way. We want to have liquidity staying throughout the market. We want to have, the areas that need to lead the market, but with broad action as well.
So interest rates and the Iran situation are probably going to be the two biggest things.
That's about it.
Keeping an eye on.
That's about it. With earnings most of the earnings behind us.
If they resolve something with Iran, then, interest rates will probably start coming down because they don't have that fear of inflation. And I mean, I think that's the key to it all.
The thing with Iran though, is I think, I can't speak for what goes on over there, but I can assume that there's an attempt to drag this on to also have some effect on midterm elections, just to muddy the water a little bit. Hopefully something can get done beforehand. Obviously, this has not played out like we intended it to. So we need to find an off ramp sooner than later, and get everything flowing as far as oil goes, because we have it. We talk about the pressures of energy here. Throughout the world, it's a lot worse. So that's why I'm not understanding why other countries haven't put pressure on us or tried to get involved in some capacity to get things settled, so that they can get better on better footing with Brent and Brent prices.
Well,
So
maybe this will be the month they finally do it.
let's keep those hurricanes away too,
Keep
because
those
I don't
hurricanes.
need to freak out and
Yeah.
put everything up. And
Although you look good in yellow, I
well,
gotta say.
the thing is, you always do this stuff here in Sarasota, and outside of Milton a few years ago, it's always been a waste of time.
Yeah. Yep.
So knock on wood. Let's hope it's still a waste of time.
All right. Well, thanks again for joining us. View from the Ranch. Stay tuned for next month's episode in September. And I have no idea what you're gonna wear there, but we'll have to. Think
Anybody
about
has an
that.
idea, email Greg at
Yes,
gp@ranchcap.com.
I will make Brad wear it. So, all right. Well, thanks for joining us, and God bless.
Take care.